Hi, Austin and Robert. First, I want to say I'm a huge fan of your show, and I recently started listening a few weeks ago, and I've already learned a ton. Your invaluable insights on what ETFs to invest in has been a game changer for my personal portfolio. A little more about me. I'm in my late 30s. I'm a medical professional who just separated from the Army after close to 13 years in service. I have no debt, about $150,000 in a Roth IRA, $350,000 in a traditional brokerage account, and another $315,000 in my thrift savings account. My new job in the private sector will pay me $160,000 a year for working about 30 hours a week, and I'll also be able to collect an extra $30,000 a year non-taxed in disability income from the military. My question is, I will not be able to invest in my new job's 401k for the first 6 months. So I want to know what retirement investment options are out there that I should consider to reduce my overall taxable income. Thank you for your awesome expertise, and I look forward to your response. Robert, I'll let you kick this one off, but I want to preface your answer with, I don't know why this person wants to reduce their taxable income at $160,000 a year. Like, don't get me wrong, that's a lot of money to make, and you are certainly paying taxes, but why do you think they might want to do that?
I think it is quite prevalent in society that a lot of people put the cart before the horse. They start making money, and immediately, instead of focusing on building that money into wealth, they're worrying about where are all the shortcuts? What are all the hacks to help me make more money and pay less taxes? And I think that comes from a societal message that the IRS is the boogeyman and it's bad to pay taxes. You and I don't agree with that. We believe that the tax bill, all of the tax books are there for us to learn from and utilize to our best advantage. I think this happens more frequently than we believe, and I just don't understand it. Like you always say, Austin, pay the tax bill, pay the tax man. Do what you can to make sure that you're using it to your most benefit, but it doesn't mean you should be trying to escape taxes. They're there for a reason, and if you really understand the advantages and how to take advantage of them, everyone wins. So I don't quite get it either, and in this instance, $160,000 a year is a lot of money, but I wouldn't be concerned with how do I beat the tax man out of a little bit of money at this point in my career.
Yeah, so tactically speaking, if you really wanted to reduce your taxable income, that means that you would contribute toward your traditional IRA, your pre-tax IRA, so you could write off that contribution of $7,000. You would contribute as well to your HSA, about $4,300 there for self-only coverage and $8,550 for family coverage. So I'm not sure if you're married or not. I'm not sure if you had mentioned that, but long story short, we're talking about $12,000, maybe $11,000 or $12,000 here of money that you can write off against your taxable income. At $160,000, your effective tax rate's probably in the low 20s. So you could probably save maybe $2,500 in taxes, which is great. But remember, the money that you're saving today means that you have to pay in the future, right? The traditional IRA means that all the money you take out of it in the future is taxable. And who knows if you're going to be making more or less in your retirement age, but more importantly, who knows what those tax rates will be, right? As you might remember, the big, beautiful bill solidified the lowering of tax rates by about 2% per bracket there and increased the standard deduction, which essentially is going to allow middle class theoretically to have more of their income stays in their pocket on an annualized basis. That's up for debate, of course. But at the end of the day, that was just because some flippant bill was signed into law, right? What happens in 30 years from now when another flippant bill is signed into law that says, no, we're actually going to raise the tax brackets and everyone's going to make, oh, you have a bunch of money in your retirement account, so now you got to pay more on that money because I'm a politician and I say what I say goes, right? So there's a lot of who knows what's going to be in the future. And for myself and Robert, we think that since we can't predict the future, we want to be able to know what we have to pay, which is zero in taxes on those Roth IRA profits. So if I were in your situation, I would use this as an opportunity to max out the Roth IRA and go that route. However, if you really want to lower your taxable income, traditional IRA and HSA are the best ways to do that.
And I think the only other addition to what you broke down is open a business. If you start an LLC and you open a business and have a side hustle, that is one way to lower your tax burden because you will have automatic write-offs from starting that business. You could get into real estate with short-term rentals. There's some good programs there. that'll help you have some write-offs and some depreciation to help you lower your tax burden. But otherwise, everyone needs to understand to exploit the tax bills for why they're there and the rules, but don't ever break the law to try and save on taxes. That's a terrible strategy. But those are the goods. That's what you can do in this situation where you're a high earner, but you're a W-2 employee, is do what Austin said to get the max benefits there, but then also look into real estate and look into opening a business.